In the summer of 1929, Joe Kennedy was one of the richest men in America. He'd made fortunes in stocks, in movie studios, in liquor during Prohibition. He knew everyone on Wall Street. He was the ultimate insider. One day in September 1929, Kennedy stopped to get his shoes shined. The shoe shine boy started giving him stock tips, told Kennedy which stocks to buy, explained his system for picking winners. Kennedy went back to his office and sold everything, every stock, every position, completely out of the market within weeks. 1 month later, the stock market crashed. It fell 89% over the next 3 years. Millions of Americans lost everything. But Joe Kennedy kept his fortune. He actually grew it by buying assets at the bottom. When asked later why he sold, Kennedy said that when shoe shine boys are giving stock tips, the market has nowhere to go but down. If everyone who can buy has already bought, there's no one left to push prices higher. But that's the public story. The real story is that Kennedy was an insider. He knew what the smart money was doing. And in the summer of 1929, the smart money was leaving, quietly, without announcements, without warning the public. Kennedy wasn't alone. Bernard Baruch, the legendary financier and advisor to presidents, sold his stocks in early 1929. He'd been reducing exposure for months. By October, he was almost entirely in cash and gold. The Rockefellers reduced their stock market exposure throughout 1929. John D. Rockefeller, Jr. famously made a public statement in October 1929 saying he was buying stocks to show confidence. But his family office had been selling for months before that statement. The public buying announcement was cover for private selling. Percy Rockefeller, William Rockefeller's son, sold $50 million in stocks in the months before the crash. He was on the board of multiple corporations. He knew what the balance sheets really looked like. These men didn't get lucky. They followed a playbook. They watched signals the public never sees. They had access to information ordinary investors couldn't get. And when those signals flashed warning, they exited. The public didn't exit. The public was told to stay invested. Irving Fisher, the most famous economist in America, said in October 1929 that stocks had reached a permanently high plateau. The newspapers were optimistic. Brokers told clients to buy the dip. The public believed them. The elites didn't. The elites sold to the public. Then the market collapsed. This is the exit playbook. It worked in 1929. It worked in 2008. And it's being executed right now. Let me show you how the playbook works, who's following it today, and what they know that you don't. The 1929 exit wasn't random. The elites who escaped were watching specific signals. The first signal was credit contraction. In 1928 and early 1929, the Federal Reserve started tightening. They raised interest rates. They reduced lending. Credit was getting harder to get. When credit contracts, leveraged speculators get squeezed. They have to sell to meet margin calls. Selling pressure builds. Smart money sees this before prices reflect it. The elites in 1929 watched the credit markets. They saw tightening. They knew what it meant. They sold before the tightening crushed prices. The second signal was insider behavior. Insiders, executives who run companies, have to file when they buy or sell stock. In 1929, these filings showed a pattern. Insiders were selling throughout the summer. The executives who knew what was happening inside corporations were getting out. Kennedy watched insider selling. He knew these men. He talked to them. When they started selling, he paid attention. The third signal was smart money positioning. The big investment pools, the wealthy families, the professional speculators, they leave traces. Their buying and selling moves markets. If you know where to look, you can see when they're reducing exposure. In the summer of 1929, the big pools were distributing. That means they were selling their positions gradually, feeding them into the market without crashing prices. The public didn't see this. The insiders did. Kennedy, Baruch, the Rockefellers, they were watching all three signals. credit tightening, insider selling, smart money distributing. When all three aligned, they knew the end was near. But here's what made the playbook work. They didn't announce they were selling. They didn't warn the public. They needed buyers for their stock. If they announced a crash was coming, prices would collapse before they could exit. So they sold quietly. Some of them even made public statements expressing confidence. They provided exit liquidity for themselves by keeping the public confident and buying. This is the playbook. Watch the signals. Exit quietly. Let the public hold the bag. Now let's look at 2008. In 2007, the housing market was starting to crack. Subprime mortgages were defaulting. The instruments built on those mortgages were losing value. But the stock market kept rising. The public was told everything was fine. The elites knew it wasn't fine. And they started executing the playbook. Goldman Sachs is the most documented case. Throughout 2006 and 2007, Goldman was selling mortgage-backed securities to clients. They packaged subprime mortgages into complex instruments and sold them as safe investments. But internally, Goldman knew these instruments were garbage. Their own analysts called them shitty deals in emails that later became public. So while Goldman was selling these products to clients, they were simultaneously betting against them. They bought credit default swaps that would pay off when the mortgages failed. They were short the very products they were selling as safe. Goldman made $4 billion from these bets in 2007. Their clients lost billions on the products Goldman sold them. Same playbook. Exit quietly. Let someone else hold the bag. Goldman executives were also selling their personal stock. CEO Lloyd Blankfein sold $45 million in Goldman stock in 2007. Other executives sold hundreds of millions more. SEC filings document all of it. They weren't selling because they thought the stock was fairly valued. They were selling because they knew what was coming. The same pattern appeared across Wall Street. Countrywide Financial, the largest mortgage lender, was ground zero for the subprime crisis. CEO Angelo Mozilo sold $140 million in stock in 2006 and 2007. While selling, he sent emails to colleagues describing the loans his company was making as toxic and poison. He sold. His shareholders lost 99% when the stock collapsed. Merrill Lynch CEO Stan O'Neill pushed his company deeper into subprime. When the positions blew up, he was fired. But he walked away with a $161 million severance package. He didn't lose anything. Shareholders lost 80%. The playbook was running perfectly. Insiders were selling. Smart money was positioning short. Credit was starting to tighten. Anyone watching the signals could see what was coming. But the signals weren't on CNBC. Jim Cramer was telling people to buy Bear Stearns a week before it collapsed. The newspapers were talking about a soft landing. The Federal Reserve was saying subprime was contained. The public believed the reassurances. The elites didn't. The elites were already out. By September 2008, when Lehman Brothers collapsed and the market crashed 57%, the elites had exited. Many of them had positioned short. They made money on the crash they knew was coming. John Paulson, the hedge fund manager, made $15 billion personally in 2007-2008 by betting against subprime mortgages. He saw the signals. He followed the playbook. He got rich while millions lost their homes. Now let's look at what happened in 2020. In January 2020, senators received classified briefings about COVID-19. They learned how serious the virus was. They learned it would likely become a pandemic. They learned the economic impact would be devastating. What did they do with this information? Senator Richard Burr, chairman of the Senate Intelligence Committee, sold $1.7 million in stocks on February 13, 2020. He dumped hotel stocks, travel stocks, anything that would be crushed by a pandemic. 3 weeks later, the market crashed 34%. Senator Kelly Loeffler sold millions in stocks starting January 24, 2020. The same day, she received a classified Senate briefing. She sold retail, restaurant, and hospitality stocks. She bought stocks in companies that would benefit from people working from home. Senator Dianne Feinstein sold $1.5 to $6 million in stocks in late January and February. Senator James Inhofe sold stocks the same period. These weren't random trades. They weren't coincidental timing. They traded on classified information about a coming pandemic while the public was told everything was fine. The SEC investigated. Some referrals were made. Nobody went to prison. The playbook worked again. But senators weren't the only ones executing the playbook in 2020. Corporate insiders sold $9.2 billion in stock in February 2020, before the crash, the heaviest selling since 2015. Executives at companies across every sector were dumping shares while telling employees and shareholders to hold. Hedge funds were positioning short. Bridgewater, the world's largest hedge fund, built a $14 billion short position on European stocks in late February. They knew what was coming. Then March hit. The market crashed 34% in 23 days. The public panicked and sold at the bottom. The elites had already exited at the top. When the Federal Reserve printed $4 trillion and the market recovered, the elites bought back in. They sold high, bought low, made fortunes. Same playbook, same result. Now let's talk about what they're doing right now. In 2021, corporate insiders sold $69 billion in stock, the highest level in recorded history, not by a little. By 30% over the previous record. Jeff Bezos sold $997 billion in Amazon stock. Mark Zuckerberg sold $4.5 billion in Meta stock. The Walton family sold billions in Walmart stock. Elon Musk sold $23 billion in Tesla stock. These aren't normal portfolio rebalancing trades. These are massive exits from positions they've held for years or decades. The selling didn't stop in 2021. In 2022, insiders sold another $52 billion. In 2023, $44 billion. The pace has slowed, but remains historically elevated. And look at what they're buying instead. Bill Gates has become one of the largest private farmland owners in America. He owns 270,000 acres across dozens of states. Farmland, not tech stocks, not bonds, dirt. Jeff Bezos has bought massive estates and ranches, real assets, land, things that exist outside the financial system. Ray Dalio has been public about owning gold. He calls it insurance against monetary chaos. His fund holds billions in gold and gold-related assets. Stanley Druckenmiller announced in late 2023 that he was betting on gold. This is one of the greatest traders in history. He managed George Soros's quantum fund. When he moves, it means something. Warren Buffett is sitting on $189 billion in cash. Berkshire Hathaway has never held this much cash. Buffett has said he can't find anything worth buying at current prices. He's waiting. For what? These aren't conspiracy theories. These are SEC filings, public interviews, documented trades. The elites are telling you what they're doing. They're just not telling you why. The signals they watch are flashing again. Credit is tightening. The Federal Reserve raised rates from 0% to 5% in 18 months, the fastest tightening in 40 years. Credit conditions are the tightest since 2007. Insider selling is elevated, 4 consecutive years of above-average insider selling. The executives who know their companies best are reducing exposure. Smart money is positioning defensively. Hedge funds have reduced equity exposure. Family offices are moving to real assets. Sovereign wealth funds are buying gold. The yield curve inverted. This happens when short-term rates exceed long-term rates. It's inverted before every recession since 1970. It inverted in 2022 and stayed inverted for the longest period in history. Bank failures appeared. Silicon Valley Bank, Signature Bank, First Republic. 3 of the 4 largest bank failures in American history happened in 2023. The system is cracking. All the signals that preceded 1929, 2008, and 2020 are present now. The playbook is being executed. Insiders are selling. Smart money is hedging. cash levels are historically high. But here's what's different this time. In 1929, the Federal Reserve was small. They couldn't intervene meaningfully. The crash had to run its course. In 2008, the Federal Reserve had room. They cut rates from 5% to 0%. They printed $4 trillion. They had ammunition. Today, the Federal Reserve has less room. They've already printed $8 trillion. Government debt is $38 trillion. The tools used in 2008 are already deployed. The next crisis will require intervention larger than anything before, and the capacity for intervention is limited. Either they print so much the dollar collapses, or they don't print enough and the system collapses. The elites see this, they know the math. They understand that the next crisis may not have a clean rescue. That's why they're exiting now, not because they know the exact timing, because they know the setup is dangerous. Here's what the playbook tells us about timing. The elites don't time tops perfectly. They start exiting when they see danger. They exit gradually. They often leave money on the table by exiting early. Joe Kennedy sold in September 1929. The market peaked in October and crashed into November. He sold a bit early. He didn't care. He preserved his fortune. Goldman executives sold throughout 2007. The market didn't crash until 2008. They were early. They didn't care. They preserved their fortunes. The 2021-2024 insider selling may be early. The market could go higher before it crashes. The elites don't care about catching the exact top. They care about not being there when it falls. This is the part of the playbook the public never understands. The public tries to time the top perfectly. Stay in until the last moment. Maximize gains, then exit right before the crash. It doesn't work. Nobody times the top. The elites know this. So they exit early. They sacrifice some upside to guarantee they avoid the downside. The playbook is running right now. The signals are flashing. The exits are happening. The question is whether you see it or not. Let me tell you what the elites are not doing. They're not buying stocks at all-time highs. They're not putting money in bonds paying less than inflation. They're not keeping their wealth in dollars in American banks. They're not believing the soft landing narrative. They're not trusting that the Federal Reserve has everything under control. Look at what they do, not what they say. Their actions tell you everything. Selling stock at record pace, buying farmland, buying gold, holding historic levels of cash, diversifying internationally, moving to hard assets that exist outside the financial system. This is the exit playbook. It's documented. It's public. It's being executed right now. If this changed how you see what the wealthy are doing with their money, if you finally understand that their actions contradict their public reassurances, then you're starting to see the playbook. Subscribe if you want to understand what comes next and how to position before the exits close. Because the elites are not going to announce when the crash comes. They're going to be gone before it happens. Same playbook. 1929, 2008. Now. They're selling. You're buying. And when the music stops, you'll discover there aren't enough chairs. There never are.